Welcome to My Talk, the podcast series brought to you by ISS Markets Intelligence. Thank you so much for tuning in. The focus of our discussions on My Talk is the global retail financial services business and its many subsectors: asset management, wealth management, life insurance, banking, fintech, In the coming episodes, we will be showcasing some of that vast array of research pieces that we deliver, covering all these various sectors of the financial services business. For more than 3 decades, ISS Market Intelligence team has been a passionate student of this business, and our specialty here on this podcast is to explore what I would call the second day story. So not just the headlines, the industry headlines, but really try to dig in deep and try to understand what's going on with the help of industry experts. We create new episodes monthly, so please do subscribe to our podcast on the platform of your choice. My name is Goshka Folda. I am your host and Global Head of Research at ISS Market Intelligence. Can you believe that we are almost nearing the half-year mark of 2024? And it has been on this end that ISS Market Intelligence an incredibly busy 5 months and a couple of days. We have been working on a lot of different research stories around the globe. So don't feel badly for us. Actually, this is the best time when we get to think about the business and discuss it and mobilize our vast data banks around the world to tell stories about what's not only happening now, but what's coming tomorrow. And one such research project that has been, in particular, I think, something that I have been incredibly supportive of and excited about is a global white paper on asset management revenue. You who know me know how passionately I feel about understanding the profitability drivers of the asset management business, wealth management business, really all businesses that we cover, but those two probably most importantly. So it is with great pleasure that I will discuss this global white paper, which has just been released. And invite you to listen to my conversation with the two researchers on the ISS Market Intelligence team who led the creation of this interesting report. Joining me today are both repeat guests: Christopher Davis, who heads our U.S. investment funds research, and Ben Reed-Hurwitz, who heads our EMEA Research. Since both have been here before, I will ask you to their bios on their LinkedIn pages. But let me offer a couple of fun facts, and I hope I did not tell my guests that I was going to do it, so I do hope this is okay. Otherwise, our editor will have to do some quick snips here. Dog, who's named Oliver. And whenever Christopher is working from home and we're on a Teams call, I insist that Oliver make an appearance because he is my favorite. Ben and I, meanwhile, go some ways back, and we have many interests that we share: traveling, Europe in general. He's now located, of course, in our London office. But I think one of the things that we really love, there are actually two things. We both love opera and also mysteries. Arthur Conan Doyle and his super sleuths. Welcome to you both.
Thank you.
Thank you. Oliver is sitting at my feet right now. So.
Wonderful. Thank you, guys. Thank you, Christopher. So let's dig right in because this is a really interesting report. Lots of data mobilization. Some of our newest data sets, including our fees and expenses data sets in SimFund Global that have just arrived in the last little while. And I'm glad that we are able to immediately mine them for insights insights. But let's start with management business. Traditionally, managers, of course, have focused on asset growth. But in the paper, you're arguing that perhaps asset growth isn't the be all and end all of this business anymore. What do you think should managers be looking in addition to the traditional assets under management benchmarks? Ben?
I think the next place to look is really going to be fund revenue. And the reason for this is, as you said, AUM was the traditional measure. And the reason for this is, as you said, AUM was the traditional measure. And it was sort of assumed that as AUM grew, revenue would really grow in lockstep. But increasingly, this no longer appears to be the case. And that's really the big finding coming out of this report. When Christopher and I looked at the 2020 report, when Christopher and I looked at the 2023 data, we saw that in the US, UK, and the European cross-border markets, that it was no longer the case that sort of AUM and revenue tracked together. And in fact, when it came to growth rates, there's actually a difference over. And it's really one factor sort of stands above the rest in driving this divergence. And it's something talked about a lot. But again, often we're talking about sort of how much AUM and what the flows are here, but it's the adoption of sort of low-cost indexing solution wealth spectrum in Europe and the US. And this adoption in the markets has also sort of picked up steam because it seems as these solutions have increasingly been adopted, a positive feedback loop forms where essentially, whether pushed by regulators, the more they're talked about, the higher essentially cost of investing becomes on the agendas of advisors and investors. And really coming into focus, and you know it very well, Goshka, because you've seen it in multiple markets with regulators, the idea of total cost to consumer, both on the product side and on the advice side. And we have seen both, but it's really been product costs have sort of faced the brunt of the scrutiny, particularly in those markets where we've seen product costs and advice costs separated. And with this, we've seen a groundswell of low-cost indexing solutions. And now the money coming into the business, or the money sort of replacing and sort of substituting for current money, again, has this much lower cost, and therefore revenue's moving in a much different way. All that being said, another interesting we looked at, even though index's share of AUM has increased sort of 15% or more in those markets over the past decade, active funds, active management is still about 90% of the revenue. So again, just watching where the money goes isn't going to sort of tell you where the revenues sort of relate to your profitability in the end. So this paper is really a story of that, with the US obviously being the prime focus, given how far along they are on index adoption.
Yeah, that's a fantastic opening, Ben, and you touched on so many important points. A fantastic opening, Ben, and you touched on so many important points. But that metric that you delivered, that 90% of the revenue being tied to active, I think is a really stunning result. But you mentioned the U.S., so let's pivot to Christopher and his thoughts about the U.S. market. Clearly, if anything, the U.S. marketplace, as my great friend Avi Nachmani used to say, the world's largest laboratory of asset management and wealth management ideas, without any doubt, is in many ways foretells developments in other markets. We've recently seen the index fund or index ETF assets surpass the 50% mark in terms of the overall asset pool in funds with growth and revenues for the U.S. managers.
Well, Gushko, it looks pretty catastrophic at first blush. Keep in mind that a decade ago, active funds were still more than 70% of the assets. Imagine, for example, if you were a car manufacturer and traditional vehicles, and the share of electric vehicles went from 25% to 50% in a decade, you'd say the internal combustion engine is toast. But if you look at the financials, active management really isn't toast. Even with less than 50% market share, toast. Even with less than 50% market share, active funds in the U.S. still generate more than 85% of the revenues. Not as successful or not as big of a share as active managers globally. Ben had referenced 90% earlier, but still 80% share. Pretty impressive at first blush. Now, of course, a big reason is that investors have flocked to low-cost index funds, meaning an ever larger slice of the assets is invested in funds that generate relatively little revenue. And we've also seen a proliferation of new kinds of index funds, thanks to kinds of buyers into the index fund fold. But if you look at standard measures of profitability, active managers have coped pretty well with this whole state of affairs. Operating margins sunk in the mid-2010s, but by 2021 they reached heights last seen in the 1990s, and I don't know an asset manager that isn't a little nostalgic for those days. And managers did get there with a little bit of luck. Markets were mostly up over the past decade, with some short little downturns along the way. But managers also consolidated. They cut costs. They removed dead weight from their product shelves. And those two factors restored profitability to the glory days of the business. Unfortunately, in 2022, we saw some of this luck run out. There were major declines across asset classes. And when markets rebounded last year, profitability did not. We just published our annual survey of public asset manager profitability and found that for the median manager, operating margins went from something like 33% to 25% in just a year's time. And the main reason for that is active managers are suffering from a sales drought. Just a handful of active funds are attracting flows, full of active assets, still generating almost all of the revenues. This pool is shrinking at an accelerating rate. So active managers are going to need to have to find new sources of organic growth, or we're going to see a continuation of the consolidation story that we saw in the 2000s.
Christopher, so well said. And I think you kind of mentioned the idea that there has been, I would say, a cleansing of the product shelves, and or rationalization would be a much nicer word, clearly. And also there have been some new ideas, and I think you mentioned ETFs being one of the instruments able to pursue a vast array of indexing strategies, including some even now, the rage of the day in the US, of course, are active ETFs, and we are just doing some to measure that activation quotient because not all active and not all passive are made in the same format. But kind of talking, thinking through that product shelf, it has not been just all spent and reorganization, has it? Christopher, you mentioned something about the fundamental changes on the distribution side, on the wealth management side.
Right. I mean, as you know, Gashka, any growth story in business is part product, part distribution. We like to focus on products because it's more glamorous. It's easy to see. The financial press spends way more time talking about all of the new products that are coming to market. But underneath the surface have been some massive changes in how funds are distributed, and especially over the past decades in the U.S. If you go back 10 or 15 years ago, most advisors had business models that were based on selling products with transaction-based fees. The investor would pay a sales load, or they would pay an ongoing trailer fee load, or they would pay an ongoing trailer fee. In the US, they're typically known as 12B1 fees. And now we see most of the sales based on AUM-based fees. So now advisors on average are earning about 1% under management every year. And that's really changed the way that assets are managed in the US. Now, you might have noticed that while asset managers have been cutting their fees, advisors really haven't. The 1% I just cited was what we would have said 10 years ago, 15 years ago, what fee-based charge. So what advisors have been doing is they've been controlling costs to the end client by choosing lower cost investments. And, when you add some of the regulatory forces which have made the advisor-client relationship more fiduciary, like you have a recipe for an intense focus. We've seen that in the US, and we increasingly see that across the Atlantic. And we're not arguing in the paper that active managers do not have any opportunities. You mentioned active ETFs. I think that shows that active management can be an attractive proposition when it's priced correctly. And we've also seen how managers can develop new product niches that create new kinds of demand for active management. In the US, for example, defined outcome buffer funds that they're colloquially referred to didn't exist. I think even as maybe 5 years ago, didn't exist. I think even as maybe 5 years ago, they were barely a speck in the market. And today we see them, growing quite rapidly. And so when active managers can bring effective solutions at the right price, advisors have proven receptive.
Definitely. I think, Christopher, that's, such a great and balanced point of view. And you underscore that kind of the unbundling process of the advice kind of product fee. The point is also well taken that has not, and I think, Ben, you mentioned that as well. There's no specific evidence that the total cost to customer ultimately has decreased meaningfully. That's something that we haven't. We did this research several years. Really a fascinating topic. But now let's pivot to the UK. Clearly, there has been also an upheaval in advisor practices. Perhaps you can give us a little bit of background for how that has come about, because I think the impetus was similar to the US, but maybe came from different drivers.
Yeah, you're right. It was certainly a different driver. The big driver's really been regulatory in the UK and the actions of the FCA. And that story really picks up on what we're talking about sort of back in 2012 with the retail distribution review and of course the UK distribution review. And of course the UK was one of the few markets to actually fully ban embedded commission that obviously supercharged this movement to sort of fee-based practices. The thing that's important, though, for people to understand when sort of thinking about Europe in relation to what you heard from Christopher, be about 10 years back. As in, if you look at the statistics in terms of the adoption of index, it sits about a decade ago. And it's really a question now about how quickly Europe catches up, including the UK, and what their options are for adapting. But kind of keeping with the UK, sort of been future pieces of regulation that were to follow. We have the assessment of value, which puts the cost of funds right front and center, requires one to sort of justify them. And then most recently, we have consumer duty as well, which in a very simplified manner is basically a cost-benefit analysis. Which in a very simplified manner is basically a cost-benefit analysis of almost everything you do for the client, and does it sort of progress them further on their goals. So all this is to say costs are laser focused in the UK. So one, obviously, this has created that separation of product and fee. So what we've seen again is increasing attention on the product costs and probably only now is maybe there a little more attention on advice fees. We've had that increasing element on product costs. But the other part is it's actually led to a lot more outsourcing of investment solutions as well by advisors, as it's really that, again, that separation allowed more room for others to sort of handle the investment side and to sort of drive costs and performance there. And I bring that up because the UK, likely more than sort of other markets, really is seeing a dual pressure on pricing. One is this index adoption, which we've already talked about quite a bit. But the second is there are more and more consolidated sort of fund buyers, drivers of flows, and they're increasingly demanding lower price share classes. So even where there is active business, it's less than before. So it's going to take even more scrutiny from managers to understand where the sort of profitable segments are.
Yeah, that is fascinating, Ben. That second driver, which is that emerging power, if you will, of the gatekeepers, and very broadly understood as gatekeepers or the fund selectors. I know that actually you prove that with the research that you and Mark Humper do in the MPS report. That I know is the second issue will be in the fall, I believe. So we'll see more of that. But I think that also would be that. But I think that also would be interesting to hear your reflection of how these things are developing in the continental Europe, so outside of the UK, in Europe, because clearly most jurisdictions there, you could make a case that MiFID in some cases, MiFID in some cases did something, and certainly Netherlands have gone in the kind of a commission ban way, similar to other markets like the UK and Australia. But by and large, continental of massive regulatory initiative like the aforementioned retail distribution reform, or RDR, in the UK. So can you tell us a little bit what's going on in Europe?
Sure, and I think that's a great point, Goshka. MiFID II did not, in the end, go all. So you do have a different regulatory environment, and then it is worth noting you have a very different distribution environment in many of the EU markets. Many of them do sort of lack this sort of independent financial advisor channel, as we'd sort of define as IFAs in the UK. So that is an important distinction, as in many bank distribution, for example, dominates, and obviously you coming from Canada, you know how that sort of can change the economics of retail distribution. So it's important listeners understand that to begin with, and I think it is why part of the reason maybe in Europe it's been a bit more of a product story and maybe a bit channel specific. The story of index adoption, because it still has occurred en masse. Certainly, if you kind of look at AUM levels, it's not really all that far off what we've seen in the UK, even if there's different drivers. One of those drivers, though, that enforce is in fact sustainable investing. So it might interest people to know that if you were to look at Article 6 funds, so for those not familiar with the European landscape, these are sort of the non-sustainable funds. If you want to sort of use it as a SFDR as a labeling regime, but these funds index accounts for over 40% of the AUM. So if we aren't talking sustainable funds, index is actually increasingly becoming half the market, and it's very easy to see it reaching that. But if we turn to sustainable funds, in case I'm talking Article 8 and Article 9 funds, index is less than 20% of this AUM. So sustainable funds in the aftermath of SFDR was very much an active story and gave active managers an edge, and they drove very large flows in 2020 active ESG strategies. Now that turned in 2022 and 2023, where ESG sort of fell out of favor, and all this active money, almost an equal amount, flowed out, leaving sort of a net zero. But again, it showed the power and the connection between active and sustainability messaging. Sustainable investing and its growth will play a key part in determining a large portion, I think, of Europe, and where we sort of see the money goes. Now, second to that, there has been a clear ETF story in Europe. Year in and year out, ETFs are generating positive flows, basically through the good times, and the ETFs are now over 1.5 trillion. And this is part of a new asset story, but also a product substitution story. And the remarkable thing, though, is a lot of this has occurred with ETFs really only sort of being fully accessible and used in more of institutional and high net worth channels. Accessible and used in more of institutional and high net worth channels. Whereas many sort of retail wealth management platforms where they exist in Europe, and in fact, including the UK, don't really integrate ETFs that well. So there's potentially still a large retail consumer base that could provide a groundswell, of new assets. So Europe is definitely different, and there definitely seems currently to be competing narratives around sustainability and the role of active and cost. And I really think we have to watch to see if these two track more in which way investors go. Is it about having that low cost core? Or again, is it maybe a bit more aligning your investments to your values and needing a more active manager to do that? So that's really where we stand currently in Europe.
And I think it's a fascinating discussion controlling the cost of the portfolio and how, to your point, Ben, if there are still active pockets, and I think, Christopher, you mentioned the same thing, how does an asset manager recognize that the pricing still has to be right? And I think that's where the active ETFs are really coming into the story, that the interest is huge in active if it's priced right and packaged right to fit into all sorts of fee-based and discretionary portfolios. So I think that's a really, really great perspective on both the Americas and on Europe. So now we've spent a fair amount of time focused on the active side, and but what has been kind of the other side of the coin? So the growth of index funds in their various structures, what that has meant to manage capability. Christopher, let's start with you.
Well, man doesn't live by bread alone, and passive managers don't live on index funds alone either. Even the biggest index fund providers out there are surprisingly reliant. On active management. Think of BlackRock. Its roots are actually as an active manager. And it still is, depending on how you look at it, profoundly driven by active management, even though 90% passive, still 40% of its revenues come from active funds. The story is also similar for Vanguard, which its roots are as a index manager, but it has quite a notable active business. It's funny to think about the fact that index managers aren't giving up on active management. And so, maybe active managers shouldn't give up on active management either.
Yeah, that's a great point. And maybe, Christopher, to the point that philosophical divide is not really, I think, so powerful. Maybe it's vocalized, but in reality, even asset managers, that happen to be specialists on either side of either end of the active versus passive spectrum, still recognize that there are use cases sides of that divide. Ben, what do you think? How the kind of the capability of index fund provision has worked? What it has done for asset managers in Europe?
Yeah, I think the only thing I would add to Christopher's comment is it kind of goes along with his comment, as in index capabilities have often been used to support additional business lines. And they should always be seen, any asset manager's capabilities should be seen in the broader organization. And to me, index has very much been used. To give an example is many managers, for example, are using their index prowess to support their multi-asset solutions. So obviously this could be traditional unitized multi-asset funds, which most markets have seen, sort of the passive providers be in this space, or increasingly in model portfolios, because now it's giving you access to sort of that asset allocator fee. So through index, you're getting access to another revenue stream. And again, without going into too much detail, you can see something similar in the retirement business. As in many markets, whether it's index or not, asset management capabilities or not, asset management capabilities have been used to sort of bolster a retirement business, whether it's sort of a DB or DC solution. And this can also be quite popular because, again, index can help you control some of your costs within your pension funds, and this ultimately may allow you to win certain business. So I think the question for all managers out there when thinking about index capabilities is it's really a holistic question. And it really is, how does this help the rest of my business? How does this help me grow my bottom line? And index necessarily have to do that directly. And I think more than a few managers out there are using it in a bit more of an indirect fashion.
Yeah, that's also an absolutely great point. And I think Christopher's examples of both Vanguard and BlackRock are also supportive of that clearly both firms, and supportive of that clearly both firms, and particularly BlackRock, not really having come from passive, but have really risen to prominence on the strength of their passive offering, and therefore the active can trail behind. So that's a great point. So let's wrap up with Christopher. Christopher, you and I have spoken about this. Christopher, you and I have spoken about this a lot, and of course, I am a well-known, to those of you who know me, a gloom naysayer. No, not at all. I do think there are plenty of opportunities in the asset management business, but this about. And how can they think about growth and managing that revenue picture, and how do they have to change the narrative of growth as they move forward?
Well, an obvious takeaway from our work is that managers need to be more selective in where they pursue opportunities. The old game of maximizing asset growth alone, I think, is dead. I think seeking growth at the right price is rising in importance, and in sizing target markets. That's one of the big reasons why traditional asset managers are so keen on alternatives. Alternatives are probably going to remain a relatively small part of the typical retail investor's portfolio with these strategies, or fees associated with these strategies. There are many multiples of the kinds of funds we've been talking about today. So that's an example of maximizing not necessarily asset growth, but thinking about it more holistically in terms of revenues. To do this, I think it will depend on the strengths of the underlying organization. If you don't have any alternatives capabilities, no heritage in this area, I wouldn't suggest going out and becoming an alternatives manager, because that's where the revenue growth is. For some managers, they will find beyond the traditional mutual fund structure. We talk about active ETFs as one example of that. Of course, we know that investors are keen on finding different kinds of product wrappers, depending on the strategy. So we've seen product wrappers, depending on the strategy. So we've seen SMA assets rise a lot recently. We've seen some of the semi-liquid product structures also attractive in some instances. And, in a world where getting advisors' attention and showing value to advisors is increasingly important. It means that asset managers, need to become advisors' partners, and that's supporting their businesses in numerous ways. Very resource rich organizations like BlackRock do so by providing technological tools to asset managers. But we've seen, smaller scale boutique managers do the same kind of thing by supporting advisors. It builds loyalty, and that loyalty, eventual revenue growth.
Thank you, Christopher. And I think that if I were to paraphrase for the largest managers, it's about, sticking to the mantra that you've delivered to investors, which is diversify in one basket, and really try to diversify your sources of revenues as much as possible. And you raised the example of BlackRock and clearly others. For the more niche players, stick to your knitting and be focused and deliver on that, and the rest should sort itself out. Guys, this was fantastic. Thank you very, very much. It's a longer episode, but I just felt there were so many important topics that interestingly, as we continue to look at our various research, more work from Australia and also from Canada. And I think that as we look at various jurisdictions, of course, the devil is in the local details. And Ben, for example, mentioned the different pace in Europe versus the US and where we are in the market place in terms of the penetration by ETFs and index funds. But the reality is that I am seeing slowly a convergence of various trends in the asset management business globally. And this is really, wherever we look, this is really happening, even though we recognize that it's all about the local detail and color and the regulation and the structure of the market and the structure of the distribution. So this is all very, very important. And we will continue to monitor those trends. The second takeaway for me is that asset management remains a highly profitable business. Christopher Tuer will read with interest the newest piece on profitability of public managers in the US, but the vice is squeezing. I thought it was quite a wrap up 30% operating margin line to 25. I think that what this suggests is that in an environment where growth in terms of markets and flows is plentiful, I think you can always make up that shortfall in the actual margin by growing the revenue base because the asset book is growing. But right now, asset managers have to course correct or to solve for households generally not having enough financial means to kind of accelerate and intensify their saving activity or investing. Baby boomer households that have powered this business over the past 30 years are moving into retirement zone and, of course, stopping to contribute rapidly into their investment portfolios. So it's lots of, and both of you mentioned the unbundling of the asset management value chain. The takeaway game, as we like to say here at ISS Market Intelligence, or that competitive, that intense competition for asset dollars and for investors and advisors' hearts and minds is on. And I know that we'll likely share the traits of strategic forethought, data-driven decision-making, investment management excellence, and agility. And we're here to help out those of you who are interested in reflecting further on this content. This is a wrap for today. Thank you for sticking with us for a longer episode. I hope you found the discussion as interesting as I have found it. We have a number of exciting episodes, and we're going to be accelerating our releases again in the summer. It has been a very, very busy spring for us, but we're going to catch up throughout the summer. As always, I encourage you to ping us with ideas about specific topics or industry guests you would like for us to feature. Thank you. And on behalf of ISS Market Intelligence, I wish you a wonderful second half of